You felt it in your stomach. That cold, sinking feeling as the numbers on your screen turned from green to a deep, unforgiving red. You bet big, convinced this was the one, and now you're watching your hard-earned capital evaporate in real time. You're frozen, paralyzed by the loss, unsure whether to sell and accept the pain or hold on and pray for a miracle. This moment of paralysis is not a market failure. It is a failure of preparation. It is the direct consequence of entering a battle without a shield, without a plan for retreat. The market did not single you out. It simply presented a scenario you had not accounted for, and your emotional response, not your analytical skill, took command. This experience, this financial and emotional gut punch, is the single greatest reason most participants leave this business with less than they started. They confuse a good idea with a good bet. They mistake conviction for a blank check. The truth is, the market does not care about your opinion, your research, or how certain you are. It is a vast auction, an ocean of supply and demand, and it will move where the weight of money pushes it. The professional operator, the entity you might think of as smart money, understands this at a cellular level. Their primary focus is not on being right. It is on what happens when they are wrong. Let that sink in. The first thought of a professional is not, how much can I make, but rather, at what point is this idea incorrect, and how much will it cost me to find out? This is the fundamental divide between the amateur and the professional. The amateur focuses on the potential reward. The professional focuses on the quantifiable risk. One is playing a lottery, the other is managing a business. The business is the management of uncertainty. Therefore, the first and most critical skill you must master is not chart reading, not economic forecasting, but the art of defense. It is the science of risk management and the mathematics of position sizing. These are not exciting topics. They don't promise overnight riches. They promise something far more valuable: survival. Survival is the prerequisite for success. You cannot win a game you are no longer allowed to play. A significant account drawdown forces you out of the game, not just financially, but psychologically. It creates a scar, a hesitation, a fear that prevents you from acting decisively when a true opportunity does appear. So, we will not talk about finding the perfect entry today. We will talk about constructing the armor that allows you to stay on the battlefield long enough to let your skills work for you. Let's begin by separating two distinct but related ideas: risk management and position sizing. Think of risk management as the constitution for your trading business. It is the set of unbreakable rules you create in a calm, rational state of mind that you must follow when you are in the heat of the moment, when emotions like greed and fear are screaming for control. This constitution has one primary law. You must decide, before you ever place a trade, the exact amount of your total account capital you are willing to lose if this specific idea proves to be wrong. This is not a vague feeling. It is a precise dollar amount. The industry standard, and for good reason, is to risk no more than 1 to 2% of your total account value on any single trade. If your account has $10,000, 1% is $100. That is your maximum loss. Not $101. Not 150. 100. This number seems small, almost trivial to the person chasing a life-changing win. They think, how can I get rich risking only $100? This is the wrong question. The right question is, how many times can I be wrong in a row and still be in business? If you risk $100 per trade, you could be wrong 10 times in a row and your account would be down $1,000 or 10%. This is a recoverable drop. It is a painful lesson, but not a fatal one. Now imagine the person who risks 10% of their account on each trade. A $10,000 account risking $1,000 per trade. If they are wrong 10 times in a row, a scenario that is not just possible but statistically probable for even the best traders at some point in their careers, their account is gone. Complete insolvency. The game is over. The 1% rule is not a brake on your profits. It is the foundation of your longevity. It is your shield against the one thing that can truly destroy you, a sequence of inevitable losses. Position sizing, on the other hand, is the tool you use to enforce the law of your constitution. It is the specific calculation that tells you how many shares of a stock to buy or sell short, to ensure that if your predetermined exit point is hit, you lose exactly your planned amount, for example, that $100 and no more. This is where most new traders fail catastrophically. They pick a number of shares that feels right. Maybe they buy 100 shares because it's a nice round number. Or they buy as many shares as their account can afford, a strategy known as going all in. This is not trading. It is gambling with the worst possible odds, because the amount of risk is undefined. The market now has control over your fate. A professional never cedes that control. The professional calculates. Here is the process, the simple arithmetic that separates a business decision from a reckless bet. First, you have your trading idea. You have analyzed the chart, you see a potential opportunity. Let's say a stock has been trading sideways for weeks, building a cause, and now it appears to be starting a move upwards. You decide you want to buy it. The current price is, for example, $50 per share. That is your potential entry point. Second, you must define your point of invalidation. Where does the chart tell you that your idea, the idea of an upward move, is wrong? You look at the recent price action. Imagine a floor, a level of support where price has bounced from multiple times in the past. Perhaps that floor is at $48. If the price breaks decisively below that floor, your reason for entering the trade is no longer valid. The story has changed. Therefore, your protective stop-loss order must be placed just below that technical level, perhaps at $47.90. This is not an emotional decision. It is a tactical one. It is the line in the sand drawn by the market's own behavior. Now you have the two most important numbers for your calculation. Your entry price, $50, and your stop-loss price, $47.90. The difference between them is the risk per share. In this case, $50 minus $47.90 equals $2.10. This means for every single share you buy, you are risking $2.10. This is a crucial piece of data. It is the cost of finding out if you are right. Finally, we connect this back to your risk management rule. Remember our trader with the $10,000 account and the 1% risk rule? Their maximum allowable loss on this trade is $100. Now we perform the key calculation, the position sizing formula. You take your total allowable loss, $100, and divide it by your risk per share, $2.10. 100 divided by 2.1 equals approximately 47. Therefore, the correct position size for this trade is 47 shares. Not 100, not 500, 47. If you buy 47 shares at $50 and the trade immediately goes against you and hits your stop loss at $47.90, your total loss will be 47 multiplied by $2.10, which is $98.70. It is your planned $100, your predefined and acceptable business expense. You exit the trade, take the small manageable loss, and your mind is clear. You are not panicked. You are not paralyzed. You are ready to analyze the next opportunity because your capital is almost entirely intact. You have executed a professional trade, even though it was a losing one. This is because success in this field is not defined by the outcome of a single trade, but by the consistent application of a positive expectancy process. Let's visualize this differently. Imagine you are a professional architect building a skyscraper. The foundation is your risk management. The 1% rule is the specification for the depth and strength of that foundation. It's non-negotiable. The position sizing calculation is the engineering blueprint for every single steel beam. You don't just guess how thick a beam should be. You calculate the specific load it needs to bear based on its position in the structure. Some beams in areas of high stress will need to be thicker. Some in areas of low stress can be thinner. In trading, the distance between your entry and your stop loss is the stress on the trade. A wide stop loss, meaning a large distance between your entry and your exit, is a high-stress situation. To keep your risk constant, that $100, you must use a smaller position size. A narrow stop loss, a small distance, is a lower stress situation. It allows for a larger position size while keeping the total dollar risk the same. The amateur buys the same number of shares regardless of the situation. The professional adjusts the position size for every single trade to ensure the risk to the total enterprise remains constant and survivable. This mechanical, unemotional approach is what allows large operators to function at scale. They are not taking wild guesses. They are placing thousands of calculated bets, each with a small, defined risk and a potential for a larger reward. They know many of these bets will not work out. They view these small losses as the cost of doing business, the necessary expense to uncover the few big trends that will generate substantial profits. They are, in essence, running a numbers game in their favor over the long term. If you do not define and control your risk, you are on the other side of that game. You are providing the liquidity and the profits for those who do. To truly internalize these concepts, the serious man must return to the source. The foundation of modern technical analysis is contained within Richard Wyckoff's masterpiece, How I Trade and Invest in Stocks and Bonds. This is the original timeless wisdom presented in the annotated edition by Max Davidson. The annotations provide necessary context and clarity for the modern environment, ensuring the original principles of trading as a serious business, risk management, and judging the market by its own action are preserved. The link to this book is in the description below. Understanding this framework changes your entire perception of the market. You stop seeing a price chart as a random series of up and down ticks. Instead, you start to see it as a landscape of opportunities and risks. You are no longer hunting for the perfect entry. You are hunting for low-risk ideas. An idea is low risk not because it is guaranteed to work, but because it offers a clear and close invalidation point. It allows you to place a tight protective stop, which in turn allows you to take a larger position size while still adhering to your 1% rule. This increases your profit potential if you are right, without increasing your dollar loss if you are wrong. Picture a soldier clearing a room. They don't just run into the center. They hug the wall, moving from one point of cover to the next. Each corner provides a tactical advantage and a safe place to retreat if necessary. In the market, a well-defined support or resistance level is your point of cover. You enter a trade near that level, so your protective stop, your retreat path, is just on the other side. This is a high-probability, low-risk entry. The uninformed participant, by contrast, often buys in the middle of a move, far from any logical support level. They are standing in the middle of the room, exposed. Their stop loss, if they even use one, has to be placed far away, meaning their risk per share is enormous. To maintain proper risk management, their position size would have to be tiny. But they don't do the calculation. They buy their usual 100 shares, and a minor pullback against them results in a catastrophic financial loss. They were taken out of the game by a random fluctuation that a professional, who entered at a more tactical location, would have easily weathered. Now, let's address the psychological component, which is arguably more important than the math. Adhering to a strict risk management plan is simple, but it is not easy. It requires a level of discipline that is unnatural for the human mind. Our brains are wired to avoid small pains and seek large pleasures. A stop loss is a small, guaranteed pain. It is the admission that you were wrong. It is much more tempting to avoid that small pain by hoping the trade will turn around. This hope is the most expensive emotion a trader can have. Hope is not a strategy. It is a poison. When you have a predefined stop loss based on technical analysis and you execute it without hesitation, you are short-circuiting that emotional response. You are letting your rational planning self make decisions for your emotional in-the-moment self. This is why the rules must be written down. They must be your commandments. You are not allowed to move your stop-loss further away from your entry price once the trade is active. That is like a ship's captain deciding to throw the lifeboats overboard in the middle of a storm to make more room on the deck. It is a fatal, irrational act driven by the fear of realizing a loss. A loss that is on your screen is already real. Acknowledging it by selling is the only way to stop it from getting larger. Let's consider some real-world scenarios to see how this plays out. What happens when things do not go according to the textbook plan? First, the dreaded gap. You buy a stock at $50 with a stop at 48. You followed your rules perfectly. You go to bed, and overnight, disastrous news comes out about the company. The next morning, the stock doesn't open at 49 or 48. It opens at 35. Your stop-loss order at 48 was bypassed completely, and your position is automatically sold at the first available price, which is 35. Your planned loss of $100 has just become a loss of several $100s. The amateur sees this as a sign that stop-losses don't work and the market is rigged. The professional sees this as a rare but expected cost of doing business. It is the equivalent of a factory having a machine unexpectedly break down. It's not ideal, but it's part of the operational risk. This is precisely why the 1% rule is so critical. Even if a gap causes your loss to be 3 or 4 times your planned risk, a 3R or 4R loss in trader shorthand, it still only represents a 3 or 4% drop in your total account. It is painful, but it is not the end of your career. The person risking 10 or 20% on that trade is now facing insolvency. Your risk plan protected you even when it failed. It contained the damage from an unpredictable event. Another scenario is the winning streak. This is paradoxically one of the most dangerous times for a trader. After a series of successful trades, confidence swells. You start to feel invincible. You think you have figured out the market. The temptation to abandon your rules becomes immense. Why am I risking only 1% when I'm clearly on a roll, you might think. I should increase my size and really press my advantage. This is pure emotion talking. This is greed. The moment you deviate from your plan is the moment you introduce the potential for a catastrophic loss. The market has a cruel way of humbling the overconfident. The very trade where you decide to double or triple your normal risk is often the one that turns against you with shocking speed. A single undisciplined trade can wipe out the profits from 10 disciplined ones. Your process must be the same on the 10th win as it was on the 10th loss. The market demands unwavering consistency. Finally, consider the opposite, the losing streak. You follow your rules perfectly. You calculate your position size. You set your stop loss. And you lose. Then you do it again, and you lose again, and again, 5, 6, 7 times in a row. This is where your psychological fortitude is truly tested. Your capital is protected. You've only lost 5 or 6% of your account. But your confidence is shattered. You start to doubt your analysis, your system, yourself. You feel an urge to stop trading altogether, or worse, to take a random shot just to get a win and feel good again. This is the moment where the professional shines. They understand that losing streaks are a statistical certainty. No system is right 100% of the time. If your system has a win rate of, say, 50%, the odds of having 7 losses in a row are low, but they are not 0. Over a long enough career, it will happen. The professional trader trusts their process. They know that as long as their winning trades are, on average, larger than their losing trades, the system will be profitable over time. They calmly take the next setup that fits their plan, execute it with the same discipline, and continue the process. They are playing the long game. They are managing their psychology just as carefully as they manage their capital. They know that breaking the rules out of frustration is the only path to guaranteed failure. So the action plan is this. It begins not on the screen, but on paper. Before you place another trade, you must write down your risk management constitution. Rule 1. What is the maximum percentage of your total trading capital you are willing to lose on any single idea? Write it down. For most, this should be 1%. Rule 2. How will you determine your stop loss? It must be based on a technical reason, a break of support, the violation of a trend line, a failure at a resistance level, not on an arbitrary dollar amount you are comfortable losing. Rule 3. You will calculate the position size for every single trade before you enter. No exceptions. The formula is your total risk in dollars divided by your risk per share. Rule 4. You will place a hard stop-loss order in the market the moment you enter a trade. Not a mental stop. A real order with your broker. Rule 5. You will never, under any circumstances, widen your stop-loss once the trade is active. You can move it in the direction of the trade to protect profits, but never away from it to give a losing trade more room to run. These 5 rules are your shield. They are the barrier between you and the destructive emotions of fear and greed. They transform trading from a stressful, chaotic gamble into a calm, methodical business. It is a business of probabilities, not certainties. Your job is not to predict the future. Your job is to structure your trades so that when you are right, you are paid well, and when you are wrong, you lose very little. This is the only secret. It is the core logic that underpins all successful speculation, from the days of Jesse Livermore to the high-frequency algorithms of today. The technology has changed, but the principles of human psychology and sound financial management have not. If this approach to the market as a disciplined business resonates with you, continue to listen and learn. The path to consistency is paved with rules, not emotion. Your long-term success will not be determined by your single greatest winning trade, but by your disciplined management of all the small, inevitable losing ones. Control your risk, and you give yourself the opportunity to let your profits take care of themselves. That is the voice of the market, a message written not in hope but in mathematics.